Good morning. Welcome to Market Monday for May 5th, 2025. Last week, the flagship measure of economic growth, the GDP, was released for the first quarter, and it was actually negative. Uh-oh, right? We haven't had a negative GDP since 2022, when, if you recall, we had 2 quarters in a row of negative GDP. Or did we? We've talked about this over the years at Market Monday. This economic data, GDP, unemployment, so many others are revised multiple times months after the initial release. Case in point, the second quarter of negative GDP in the second quarter of 2022 was actually revised to be positive. See that right there? And not only that, this is inflation-adjusted GDP. So in nominal terms, it was even higher. So number one, we didn't have 2 quarters of negative GDP. And even if we did, that is not any definition of recession. Number 2, the NBER, the National Bureau of Economic Research, the official arbiters of recession in the US, doesn't even use GDP in their evaluation of recession. Have a look. Industrial production and manufacturing, employment and jobs, income. Of course, all this is to say, just because we get 1 quarter of negative GDP, it's not cause for major concern. Especially because, we talked about this a few weeks ago, imports front-running the tariff tantrum, subtracting almost a full 5% from GDP. Big gains in equipment spending right here help to offset the declines from imports. Perhaps a better measure of underlying domestic demand is something called, ready? Real final sales to domestic purchasers. It's just GDP, which we just looked at, taking out changes in inventory here, net exports here, and government spending here. Here's what that looks like next to GDP over the past few years. Here's that negative GDP print right here, and this metric representing domestic demand rose at 3%. So pretty darn strong from that standpoint. Even so, the markets are still down this year so far, and whether the bottom is in, we'll let that unfold. But could this sell-off have actually been healthy? Let's zoom out and look at a 2-year rolling return in the S&P 500 stock market. First, we see this gyrating pattern. So while the average is 20% since 1990, we don't actually experience the average very often. But we see, whether it was .com, global financial crisis, 2021 and the bear market of 2022, when the 2-year returns start getting a little high, there's usually some type of corrective force to bring it back in line, closer to the average. So perhaps this sell-off was a necessary breather, bringing us back down to planet Earth, so hopefully we can avoid going negative as in years past. Have a great week.